All right, we are live. Welcome, Portfolio Builder members. Today we're going to cover our Tuesday Emerging Markets Trade Alert. Merry Christmas to everyone. Our trade alert today is to hold your long put expiring January 10th. And if you are just entering the position, you will need to add that. So if you took last week's trade, we're up slightly. And the basic strategy is to buy the asset, put the put option in immediately. That put option will immediately create the maximum loss we can have in the position. And then our goal is to generate more profit on the underlying asset over the period versus the cost of our downside protection. So in our trade alert on the 17th, we entered at 44.21 and bought the 44.23 put for 61 cents. And currently it's up about 35 cents. We've got 35 cents of value left in our put. And our net profit currently, which is open and not being closed out today, is 9 cents a share. Our SPY trade is slightly down 30 cents today. And I do believe we have a great chance for that to turn into a profit by Friday. The TLT trade, which is an inverted option caller, essentially we're betting down on the TLT, is up 24 cents a share. And this is because we have seen the underlying asset depreciate by 50 cents, which is negative for our underlying asset. However, we collected $1.33 on the inverted option caller and would be able to purchase that back for 59 cents at current. So that's up 24 cents a share. GDX has gone up, but once again, we purchased the put option. So the second you enter that position, you realize your maximum loss by purchasing the put. And this is how we can take a risky asset like GDX and emerging markets and turn it into a low volatility income strategy. So we're only going to generate a profit on GDX and emerging markets when our underlying asset can outperform the cost of the put option, which will most likely continue to be a 1 month protection. So we'll buy 1 month of protection and then lock in our maximum loss at that point in time, which is a tiny cost relative to the value of the asset. And then we can just sit back and manage that position. So I do see a few new people joining in. Welcome. And also you can get a replay of today's presentation right after we're over. Just go back to the trade alert email and click it once again. And I will unmute everybody's microphones just to see if anyone is just following the trades for the first time. Please let me know so I can help you get started and make sure you don't have any questions. Charles, how's it going? I see you have a mic.
Hey, this is Ed. This is my first time tuning in, so I don't have any positions at all. So
okay, good. Yeah, who else is just getting started so I can kind of walk you through how to follow the program? Now, Ed, how long have you been watching the trade alerts?
I only started yesterday, so I haven't been watching much.
Okay, yeah, no worries. Sure, so let me explain the program and the strategy. This is a low volatility strategy. Our goal is to generate safe returns for retirement and to protect capital at all costs. So the good part of that is it's very hard for us to lose money the way we trade. The negative to that is you're not going to get rich quick. So we don't tend to attract investors who are impatient and want to speculate and try to get rich quick. But if you're more of a safety freak, you hate volatility, and you like to just generate safe returns, that's the sort of investors who are attracted to our program. Here's a look at our returns. Now, I do want to note that I've been playing us extremely safe ever since July, when we saw a trade deal go bust by August. So we've been looking for this phase one trade deal to either escalate or de-escalate, and really played it extremely safe. Now that it does appear that China will play nice with us. We are taking on a little more risk, and we have been seeing some nice returns from that. So currently, our strategy is using this trading plan right here. We essentially have three go-to trading plans based on what's going on in the trade war. As long as interest rates are low, inflation's low, and there is quantitative easing. So that's really the bigger factors for us. After that, we can use the options to alter the way we generate a profit. So currently we are in a de-escalating trade war. So we're trading in a positive manner the SPY, emerging markets, and GDX, and we're short the bond market. And in fact, not just the bond market, but the long end of the treasuries. So this is illustrated by having a plus sign on SPY, emerging markets, and GDX, and then the negative on the TLT. Now, my expectation is at some point, probably not till after the election, we may have a high probability of going back into an escalating trade war, which has been the fear for this entire year, was that if Trump is going to try to get a win in the trade war and China is going to keep dragging their feet and kind of saying they'll do a deal and then not doing a deal, then saying they'll do a deal, then not doing a deal, and then repetitively doing this. My concern was that he was running out of time to create chaos before the election. So we were playing it safe the last several months, and sure enough, Trump gave up on the trade war, and now we have a de-escalation. But if we were to see the trade war suddenly turn around, this is our go-to strategy, and we've done well with it. So this would be short the SPY and emerging markets or equities, and then long bonds and gold. Now, most of 2019 and the returns you've seen were generated by being long the entire portfolio. So if it's really unclear whether we have a trade deal or not, we've seen all of these assets rally together as we've been in a period of interest rates heading lower. We're in a low inflation period of time, which is allowing the Fed to get away with these super low interest rates. And now we're officially entering a period of quantitative easing, which is bullish for really for stocks. But as long as there's a big fear and concern in the market, we've also seen the TLT rise with the SPY. So this has been our trading plan for much of the year. In brief periods of time, we've been able to profit from this setup right here. And just recently, we've begun using this trading plan. Now, to review the three ways we orchestrate our options, we have the bullish loose option caller. This is where we can sell an out-of-the-money call and buy an out-of-the-money put. So this is our most risky strategy. But you can see going into this trade, our maximum win or loss is $300 in either direction. So that's the riskiest option caller strategy we have. If we think we're getting towards the top of a move and there's a big risk of a sharp sell-off, we'll use a tight option caller. So we're going to sell an at-the-money call and buy a near-the-money put. And essentially, we get our maximum profit if it stays flat or goes up. And if the market were to turn around on that asset and sell off viciously, well, we've cut off our losses very quickly. So this is our neutral tight option caller. And then the third setup is the bearish inverted option caller. And as you can see in this risk graph, we actually profit if the asset travels lower. And we do this while owning the asset. So how do you pull that off? You sell an in-the-money call option, and then you purchase an in-the-money put. And so this can actually generate profit by owning the asset, taking advantage of selling an in-the-money covered call, and then buying an in-the-money put. So this is the trade we have on the TLT currently. Now let me stop and take some questions and make sure everybody understands this. Ed, have you traded options before?
Yes, I have.
Okay, so is this all pretty basic for you, or does this seem a little confusing?
No, it's not confusing. I get it.
Okay. And Charles?
Yes.
Have you traded options before? Does this all make perfect sense? Oh, he's back to silent. Okay, good. So those are our three setups. Now the trading plan, again, which is in each trade alert, tells you the day and time we're going to trade. Now, normally it's at noon Eastern, but markets close early today. So we're trading the SPY ETF Monday, Wednesday, Friday. Because it has 3 option expirations per week, it's very unique. There's no other ETF or stock that has that. Emerging markets we're playing on Tuesday, and then TLT and GDX we're playing together on Thursday. So this allows us to put the maximum amount of focus into each asset class for each trading period and keep our lives very simple, very passive. Every trade comes with a put option below the asset, so there's absolutely no reason ever under any circumstances to touch our position outside of the trading period and trading day. So this makes the program very easy to follow and for us all to get the same results. So you can talk to our members, whether we're winning or losing, we're all getting the same results because we trade the most highly liquid products at the same time each day following the trading plan. So to summarize, per $75,000 invested, you would have 100 shares of the SPY, 200 shares of emerging markets, 200 shares of TLT, and 200 shares of GDX. And this effectively gives you a 50% position in equities and then a 50% position in bonds and gold. So does this make sense to everyone?
Yeah.
Okay, great. So that's our strategy. Now, a lot of our folks are trading at a minimum, usually the 75,000, obviously. But many of our members are using their phone app to trade 7 figures with this program on the go because you do get the trades via text message. So we have investors from literally just doing one $75,000 lot to investors who are trading millions of dollars following the program. These assets are the most highly traded ETFs in the world for their respective asset class, and their option markets are extremely liquid as well. So this does allow us to essentially hardly put a dent on the market with millions of dollars, probably tens of millions of dollars following these trade alerts currently. Now, are there any questions about how the trading plan works? What our target return is? What's your portfolio look like right now, Ed? Are you all in on equities? You got cash, gold?
I have a high cash position that I'd like to use for this.
Yeah. Well, don't want to let it just get eaten away by inflation. That's certainly a concern. Okay, so let's talk about how you would jump into the program. The best probably series of days to start following the program would most likely be a Tuesday, Wednesday, Thursday, because that would allow you to enter the entire position in a series of 3 days. I don't recommend just buying the assets naked with no protection. So you're best off building the position 1 day at a time so you can immediately apply the downside protection. Now, again, we're trying to generate very safe, low volatile returns. And that's only possible when you not only have this total allocation of capital being split in equities, bonds, and gold, but also by applying the downside protection. So if you didn't want to take the Tuesday trade because the market's closed tomorrow, you might consider taking the Thursday trade, then the Friday trade. That would get you your SPY, TLT, and GDX built, and then you could hop into emerging markets next Tuesday. Or if you wanted to, you could jump into today's trade. The way the trade alert is designed, we start off with the text message up top, which gives you the instructions. Basically, we're just buying the January 10th, 2020 44.23 put per 100 shares of emerging markets. Now, when we initially put this on, that was an in-the-money put option. If you're buying this now, it's a little bit lower. than the trading price. So your maximum loss would actually be a little bit lower than where we're at right now. So you'd need to see emerging markets pull back 30 cents and you would realize your maximum loss. And in this example, it's about 1.25% on 10% of our portfolio. So the maximum loss we can realize with this trade from here through January 10th is about 1/10 of 1%. So 0.125% is the maximum loss you could generate the second you put on this put. Now on the upside, I suspect that we can see quite a rally in emerging markets because we're going into a period where 3 of the 4 largest central banks are doing quantitative easing, which is very correlated to a bullish stock market. Now, if China jumps in, which they're starting to show signs they might, we could have a serious melt up in emerging markets. We're seeing Bank of Japan, the ECB, and the Fed all doing quantitative easing at least for the next 4 months, probably longer. If we could see China jump in on that as well, I think we'd see emerging markets really thrive. So that's our position on this. The SPY ETF, we're doing a little bit different trade. I'll just pull that up so you guys can see that we've been doing extremely well on the SPY for ever since this phase 1 trade deal was announced. And this setup is a little more bullish as we've seen the SPY just really demanding capital from around the world. In this setup, we are doing a kind of a hybrid. We're taking advantage of extremely low volatility. So we're selling the 322 call in yesterday's trade. And this is when the SPY was trading at 321.56. We bought the 321 put. And then with a little bit extra duration, so you can notice the expiration on that long call, on that 323 call. Well, this setup's really neat. On the downside, if the SPY were to tank $5, $10, our maximum loss is only $1. But because of the low volatility environment, we can buy that 323 call. We actually outperform the SPY to the upside. So imagine a situation where you can buy an asset and if it crashes, you lose very little. But if it rallies, you outperform. That's a unique setup that's only possible when volatility is crushed. And I do believe it will remain crushed for the next several months because of this quantitative easing. So this is a setup we're doing in the SPY currently. Let me pull up our TLT trade so you can see how that is performing today right now. Here's a look at the TLT. Now this setup, we actually lose if the TLT traveled higher, but we generate a profit if it travels lower. So step 1 is you buy the asset. Step 2, sell the in the money call for a huge credit. You can see we picked up 263 and then buy the in the money put. And this actually allows you to own the asset, sell a massive amount of premium with that in the money covered call, and then turn around and buy the longer duration. So you can see the January 3rd, 137 put. So we will exit this position tomorrow. And currently this position is up. Now on GDX, the last piece of the trade, you can see the same setup. We bought the in the money put, which essentially realized the maximum loss going into that trade immediately. And that maximum loss was 82 cents. So we've already nearly paid that off because GDX is traveling higher. And any move from here through January 10th will essentially be a no risk profit in our portfolio. So Thursday, we'll be doing a very similar setup. We'll continue to trade the inverted option collar on the TLT. And then for new folks joining, you'll pick up your shares of GDX and enter into a put option so that you can own this very volatile but very lucrative asset without having to stomach large amounts of volatility. So those are our core positions that we're currently trading. And if I pull up some charts, I can give you A little bit of an overview of my predictions in the market. Okay, so we have 3 of the 4 major central banks printing money. They've been in a sequence of lowering interest rates. And currently it looks like they will hold on the interest rates and are planning to just purchase up a lot of bonds from their primary dealers. This turns into a lot of money flowing into equities. So at the current point, we're expecting equities to rally very rapidly to the upside. Now on the TLT, this is typically an inverse relationship to stocks. Now in 2019, they were in a period of lowering rates, which will artificially boost the value of bonds. So they did that, and now they're selling them off to the central bank. And this typically turns into an environment where stocks go up and yields climb due to the stocks rallying so hard. So we're actually expecting the TLT to crash for most of 2020, most likely to this 120 level. And I think that'll be what breaks the stock markets back. We'll take a look at why and some evidence of this. And this could be right around November or December, so long as we don't have an escalation with China before then. As far as GDX goes, wow, it is rocketing up. So that is actually probably in a big profit now. But if we look at the big picture, the last time we cut rates was 2008, leading into the crash. Okay, once again, that made the value of bonds go up. And this is the playbook for the banks. They cut rates to make the value of the bonds pop up, and then they flip it from the banks to the central bank for massive profits, and then they turn around and buy stocks on the cheap. Now this time around, they were so scared because they can't cut interest rates anywhere near what they have in the past 3 crises that they're doing it while markets haven't even crashed. So they did the rate cuts, now they're doing QE. When we do QE, stock products go up. It's just that simple. And you can see in 2008, they cut rates. That does not support stocks. What does support stocks is when they begin QE. After QE, GDX went from a level of 20 to as high as 63. Now, the problems that we're trying to bandage with QE and rate cuts this time around are far larger than what we saw in 2008. It all has to do with China misallocating trillions of dollars, and now their GDP is crashing. And this is putting a lot of pressure on all of the communities in Asia that they do business with, primarily countries they import goods from. So this is the big reason why we've seen something like 83 central banks around the world cut interest rates in 2019, and now they're segueing into quantitative easing. So my expectation is we could see a good rally in gold in 2020, but I think the big fireworks will be in 2021 and 2022 when our rates go to 0 and they do real QE. Right now, the QE they're doing, they're calling not QE because it's just the front end of the treasury. So we'll take a look at that. As far as predictions on TLT, again, I think it will crash for most of 2020 until we get through the election. At that point, we're going to have a good excuse to reopen the trade war and create a crisis, which is critical if we want to continue funding the US government with these large deficits. So let's take a look at the yield curve so we can see what we're talking about here and some evidence that this will really play out. So what I want to do is go back to 2018 and show you what happened during a raging bull market in 2018 for US equities until something snapped the markets. And what was it? Okay, so what we have here is every other month in 2018 leading up to September. And what I want you to point out is that by September, the 10-year treasury hit 3%. This is too attractive for banks to turn down. Here's why. Number one, if they believe that inflation will remain around 2% for the next 10 years, they can leverage into this trade and have a no risk return of 1% a month. Now, if you're using 10 times leverage, that's a 10% yearly return with almost no risk for the bank. So that is very hard to turn down and attracts a massive amount of capital anytime the interest rate or the yield on the 10-year gets too attractive above inflation. So just like clockwork, what happened by October of 2018, stocks began to sell off and we ended up with the Christmas massacre. So let's look at what happened to those yields as we crashed into December. And you can see immediately the market could not withstand these 3% yields on the 10-year, and it started to sell off. Stocks are tanking and money is flowing into the bond market. How did the Fed react? Well, they immediately started cutting rates, and that drove yields much lower and put temporary relief on the stock market and bond market. And so where are we at now? Well, in today's environment, the Fed is pumping $60 billion a month into buying the 1 month, 3 month, and 1 year treasuries. And they'll most likely continue to do that for much of 2020. My expectation is these yields, which are not being artificially held down by the Fed, are going to begin rising once again. And this is going to cause money from all around the world that's sitting in worthless bonds that yield perhaps negative. And this is going to be very disruptive to bond markets around the globe. So I do suspect we'll see a lot of money flowing out of bonds into general equity portfolios, as well as into high yielding US treasuries. So that's the big expectation. But once again, once it gets too high of a yield, that will make the stock market sell off and give cover for the Fed to drop rates to zero and move into QE that's in this spectrum. So buying up your 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, and 30 year treasuries. So to summarize, once again, without a crisis and leading into an election, I believe we can count on less chaos from the administration. They've successfully got interest rates super low and put us into a period of quantitative easing. So this is extremely bullish for stocks and extremely bearish for bonds until, again, that 10-year gets towards 3%. Now, we're more leveraged now than we were in 2018, and a lot of these banks are speculating that 2.8 will be the breaking point for the stock market. So from calculation, this is right around 115 to 120 on the TLT is when I would want to flip from being bearish on bonds and bullish on stocks to doing exactly the opposite. Okay, so that's a good review of our thinking and strategy. Let's go ahead and open this up for questions now. Any questions out there? Ed, you got your microphone unmuted. Any questions?
Yeah, I saw the text message this morning, but I think what you said is hold off on the EEM until next week, until Thursday.
Well, you could trade this one today. If you wanted to start following the program right now, you could jump into emerging markets today. Wednesday, we're off. Thursday, we will build your TLT GDX position. And then Friday, we'll build your SPY position. Now, if you wanted to wait, you could start Thursday. So it's totally up to you in terms of when you want to get started with each position.
Okay.
Wow, we got quite a bounce in our GDX today. But yeah, so that's really what we do, Ed. We meet every day, our whole group, Monday through Friday at noon Eastern, daily webinar, Stock Shop. Now, in some points in time, we can be very honed in on news, like when we're trying to predict whether the trade is going to escalate or not. But now we're much less news sensitive. We know what the central banks have planned. They've already forecasted that for the next 6 months. We can keep a close eye that China is purchasing the correct amount of agricultural products. But even if they're not, I think the administration and Kudlow have made it clear they're going to not judge China's sincerity for at least the next 6 months. And it's almost, it's a lot less likely that Trump will create chaos going into the election period. So at this point, it's pretty smooth sailing with our market predictions and what our trades will look like. Now, I do suspect the more attractive those bond yields become, the slower we'll see the SPY appreciate. So I do think right now, in the early quarter of 2020, we have the best opportunity to see the SPY really accelerate to the upside and for the TLT to have a massive move to the downside. It's really change of price that generates profit. So I would suspect quarter 2 and maybe quarter 3, these moves start to slow down dramatically until that yield becomes unbearable for stocks. Now, on some days, I do part of our boot camp, module 1, which is the big picture, and probably won't today, but if you do come back Thursday and Friday, I can get into more of it. I do like to try to provide some unique content each day. We have a 18 module boot camp that really gives you quite an education. And I'll just kind of flip through a few slides really quick to show you what's really interesting here. And in this presentation, we look at the last century of inflation and Fed policy and how it's impacted markets. So I'll leave you guys with this. But here is the most important chart by far. If you've been counting on stock markets and bond markets rallying and re-rallying and never ending, you got to pay attention to this chart. Who knows who Paul Volcker is?
I do.
You do. Okay, good. So the reason why we've had such a long bull market, not just the last 11 years, but really the past 40 years, is because good old Paul Volcker had to fight runaway inflation in the 70s. And that was from a whole lot of government spending after World War II. So they were creating Social Security, food stamps, everything you can dream of to provide social nets. And it wasn't just the US. The entire world was feeling relief of World War II. And after World War II, all governments worldwide went on a spending binge. They had low inflation. And so you had a massive bull market from the 50s all the way to 65. But after that, the inflation was too hard to slow down. And Paul Volcker had to hike the cost of money, or the federal funds rate, up and down, fighting inflation all the way to 20%. So Alan Greenspan comes in and starts cutting rates, doing quantitative easing. And then we get Ben Bernanke, then Janet Yellen, and now Powell. And what you can note is in each recession, they were able to fight that off by cutting rates by anywhere from 5 to 10%, and then doing quantitative easing. But what's different and unique about the crisis we're in currently, which is fear that China's growth is not just going to bottom out, but crash. And that will cause a spin on all of the emerging markets who rely on their growth for their country's growth. Well, the problem is we don't have 5% to cut the cost of money this time around. So you can understand why they're so aggressively trying to prevent a recession before it happens. We only have 1.75% that our Fed can cut rates in the next panic. So what happened the last time we had to bottom out at zero twice? Well, that was what led right into this runaway inflation in the 70s. So how did the stock market perform during that period? Well, the last time we had a situation like this was, again, coming out of World War II, lots of government spending, Cold War with Russia. Stock market loved it. You got low inflation, you've got debt growth, feeds into your companies generating profits. Stock market eats it up. And then what happened? Well, once you got inflation and you lose control of prices, you have to start hiking rates. And so from 1965 through 1980, you had a 15-year bear market in stocks and bonds. And that's what made it possible to have such a massive rally over the last 40 years. But it's coming to an end because we have no more room to cut interest rates and keep this boom going. So that's the big fear to be concerned about is, are we really out of ammunition? And probably we are. So we've got one last really round to cut those rates to zero, do some massive QE, and then hope to God that the GDP can begin growing faster than our debt. Right now, we're growing debt at 6% in the US versus growth of 2%. So that's surely unsustainable. Okay, guys, well, I'm gonna go ahead and wrap it up. This is about a 2-hour presentation. We take you through the last 100 years in the US, what's happened with inflation, interest rates, and how that's affected the stock and bond market. So definitely join us later in the week. We have another webinar Thursday and another webinar Friday. Tomorrow we're off. I will answer any last questions and then let you guys go and enjoy your Christmas.
Just one quick question. I mean,
sure.
I think the Europeans are at zero interest rates already, right?
Yeah, they're actually at negative interest rates at the ECB. Slightly.
Yes. So are you seeing the effect of what you're predicting over there already?
Yeah, so we spend a lot of time looking at Japan. That's really the fear. Is the U.S. going to take the path of Japan? Are you familiar with Japan's history? Do you remember when they were evaluating Tokyo as more than all of California in the late 80s?
Vaguely.
Yeah. Okay. So we're coming to a point. We really have two options. So, back in the 80s, everybody's worried that Japan was going to become the superpower, overtake the U.S. The same fear we have about China currently. And unfortunately, we're seeing those two countries make the exact same mistakes. And the bottom line is, if you let your real estate and bond market grow too quickly, it makes it too expensive for corporations to operate in your country. And so then the corporations bail on you and you're left over with extremely overpriced real estate and labor costs, as well as government spending that's unsustainable. So that's what happened to Japan. Now, Japan, we have a whole presentation just about China and Japan, but essentially Japan decided, and I think they can only get away with this because we had positive yielding treasuries, but Japan decided, you know what? We're not going to ever hike interest rates again. We're going to try something altogether different. So they allowed their stock market to tank in the 90s. They allowed their real estate market to tank. In fact, it tanked something like 50 to 80%. And it never has gotten back to the height it was in the 90s. And what their action was, they said, all right, we're going to give up on trying to grow. We're going to stop trying to take over the world. Let's just try to make the most out of what is profitable in our economy and weaponize our currency. So they protected their currency and bond market at all costs. And that cost was allowing their stock market and their real estate market to crash. So the US is going to be, in the near future, I'd say in the next 4 years, having that same dilemma. Do we want to put interest rates at zero and start buying up all the debt out there, all US debt with our own central bank. And if so, that would be very negative for stocks and for real estate, just like it was for Japan. But we can continue to dominate our bond market, our currency market, and try to avoid a severe recession. Or do we bite the bullet, take the medicine, and fix the underlying problem? And so the argument is that low interest rates create misallocation of capital. If you got free money, you're not going to make smart business decisions. You have to pay 5% for your loan. You're not going to go waste that loan. You're going to make sure that loan generates a profit because you're going to be on the hook to pay that interest for a long period of time. But if you can borrow money at 0%, well, we've invented this world where companies like Netflix or Uber can have a business model where they're incentivized, and they have to. They're competing with other companies. They're not incentivized to generate a profit. They're incentivized to take over market share. And because they can get free capital, they don't care about making a profit today. They can say they'll make a profit tomorrow and have these huge losses month after month, billions of dollars. So if we have interest rates staying at zero, we're going to have a lot of malinvestment in the United States and probably slow economic growth. Now, if we were to hike interest rates, that's going to bankrupt a lot of bad companies, zombie companies, but that's really the real fix. So we'll see what they decide to do. It's hard to get a population to understand this and vote on it. It's not politically popular. And in Japan, they actually realized that they couldn't get the government and the people to change their mindset until they engineered a crisis that made them change their habits. So we'll see what's happening for the US, at least for the foreseeable future. It's quite obvious that to service the massive deficits we're creating, they're going to have to eventually cut rates to zero and start buying up more spectrum in the treasury curve. Now, if they believe that this can be a short-term fix and our GDP growth is going to pop up higher and we can start to get our deficit lower, then maybe they have a miracle here. But more likely than not, we'll continue to grow debt at a faster rate than our GDP and be faced with the same exact problem that Japan faced. And that's whether we want to hike rates, get the misallocation out of the economy, have a recession, fix everything in our economy at the core, or do we want to continue bandaging it up with low interest rates and deflating the value of the dollar? And that risks losing the supremacy of the world's reserve currency. So not my job to necessarily advocate what they will do or won't do with my personal opinion, but it is my job to predict what they're going to do. So we're closely watching that. As far as the next 2 years, probably flat interest rates for this year until the bond yields get so expensive that it makes the stock market sell off. And then almost definitely they'll cut those rates to zero into 2021 and begin a bigger real QE, as they call it. But what they do once we're at 0% rates will be very interesting. Hopefully they will start hiking interest rates up after they feel like they've saved the economy from a short-term recession. Does that make sense?
Yes, it does. Thank you.
Yeah, my pleasure. Any other questions out there? All right, guys. Well, I really appreciate everybody joining us live. Again, we will have another webinar at noon Thursday and noon on Friday. Thursday, we'll trade the TLT and GDX, and then Friday, we will trade the SPY. So thank you all for joining. Hope you enjoyed the presentation, and we'll see you later in the week. Merry Christmas to all. Thank you.
Thank you.
Thank you.
Yeah, thank you.